Good evening. This is the Elliott Wave update and a little bit of the big picture update for the S&P 500 and the NASDAQ 100 with a little bit on the bonds as well. And for Sunday, March the 12th, 2023. It's a wild and crazy opening already, and the market's been reopened for an hour and 15 minutes, basically. And we've seen this rally that they're not willing to give up just yet. We've seen another bank go under receivership with the FDIC and be closed down, and that is Key Signature Bank. We've seen where the Bank of London is going to step up and buy the assets for Silicon Valley Bank, but actually that is on what they were really pressuring the Exchequer, and I talked about it in yesterday's update, the Exchequer to come in and actually take over Silicon Valley Bank's branch in London. And I think they have one in Denmark and one in Sweden. They're around. So to help the London people out and their loans and their deposits, et cetera, et cetera. So the market is taking that as, oh my God, everything's fine, everything's good. And they immediately started to race it. Now add into this, and I'll look at the bonds in just a moment, add into this the fact that we have the roll. We have the contract roll from March to June. So it looks like a gap. We did get a gap because, we did get a jump, a gap on the opening in the S&P and in the NASDAQ because of the roll out to the June contract. That's basically what's trading. If I kind of look at this and go down and just take a peek, let's just see what's kind of trading here. We have 26,000 versus 19,000, and they're rolling out. And the difference between the two is $15, $25, $20. Yeah, about $20, 21 bucks. And so it's a lot. It's a lot. And that causes this big, huge gap in our charts. Back at the ranch, how do we want to deal with this? Well, what I've had to do is I'm looking at, I didn't rearrange, but I relabeled the count. I still have 1 and 2, but here I was looking for a continuation of a third wave down. So we had that possibility we could drop. This, if I just take this out and just now add ES H23, not HD, H23, you can see it's big, but not that big. It's not way up here. So this can be likely the completion of that subminute wave 1. And then we're getting this ABC, maybe it can go higher, maybe not, and that would be subminute wave 2. So back over to just where I do have it labeled, subminute wave 1. ABC, subminute wave 2. We're not breaking any rules. Everything fits. And we can actually add very quickly just retracements on that. Now, people say, well, why didn't you see this, all this other stuff? It's like, well, I'll tell you, it wasn't that easy to see. There's so many factors, and there's such a reaction, and it's all algorithmic. I think if human beings actually had to decipher this and put it in, they wouldn't be able to do it. But what this causes was a lot of activity and just the roll and what they, how they came out of expiration on Friday. How do we want to balance that against the news, et cetera, et cetera, et cetera, as they come in and they continue to just cover positions going forward. Now, what does that suggest for this market? It suggests that we're coming up in a subminute wave 2. Cannot go above 4019. If it goes above 4019, I'm going to have to back it all up. And because this actually labels as 3, and this would then label as 3. So we get a 3 and a 3. And that doesn't make total sense to me, but it'll have to. It could be an A, B, C down. And in that case, I have to go all the way back to here and say, likely not the B wave. or this is an X wave. And I have to back it up because we're getting threes followed by threes followed by threes. And that's very hard to kind of work in. I would keep it in its channel that we've been in forever. But right now, I'm focusing on this. I'm focusing on that the move likely will hold below 40.19. I cannot guarantee that. We have so much going on, so much input that needs to be factored in, that the only thing they're factoring in right now is Silicon Valley and its deposits have been protected to the full. People are going to get paid. Oh, that's all good. That's all great. And that's what we got to live with. Now, in the bond market itself, that has changed a little bit. Those that follow on my big picture updates I've been talking about here in the bonds, that I had the possibility that the intermediate B wave would have been completed here, and if I left it as an alternate, and this would have been working its way lower, and that would be minor wave one of the first, minor wave one of the intermediate wave C wave down. But it went up too high. And then today it got up above 130. So I went back to my preferred count, which always ran together with it. And that shows an A and a B. So minor A of that primary wave B, minor B of the primary wave B were in the minor C wave. And within that, likely you completed 3 of C here. We're in a 4 of C, and we'll still rally back up. But now we just need to get back above 133. And we've got the resistance at 133.27, 135, and then 136.29, where wave C would be equal to wave A. So it's going to be a lot lower than what anticipated to get this C wave. What's going to fuel it? What's going to fuel it is that the premise that the Fed won't raise rates against what's happening in the banking system. In fact, that they may even ease rates because of what's happening within the banking system. They're trying to save their own butts. And I'm not going to go into the discussion about how this whole process, everything that we're seeing happen against Silicon Valley Bank and now other banks, you can trace it back to Fed actions. So the setup was there. It kind of really comes down to Silicon Valley, in my opinion. It's like, well, they said that they didn't plan for interest rates to go up. It's like, well, that's just bad trading, I think. Because to think that I can't go there. But in any case, so the bond market can continue to go up. Well, the equity markets are going to interpret that as like, interest rates are stopped. So maybe our October lows are it. And so they will continue to buy. Now, what's going to change that? Well, let's not forget that Monday, we do have some numbers, but it's Tuesday's CPI numbers. And that may jack us up even further. But we'll have to wait and see. So going back over to the S&P, right now, we have resistance at 39.53, 39.68, and 39.91. Let's not forget, I'm going to call 39.91 is AKA their comfort zone, which is 4,000. So my plan right now is that the market will hold below these top levels of resistance, hopefully below this, put it in. And again, we did an ABC up, and now we'll start to come back down. But you can see they've just moved back in and bought this back up $20. This is the volatility. This is that there's not a lot of players. It is Sunday, early evening, mid-afternoon here. And so to me, it's like, wow, it's a crazy move that likely will be reversed. So, but right now there's our resistance. So my expectations remain the same. And that once this is done, now that I pulled the 1 all the way down to here, we're going to roll over. And there's pick a reason. Again, the reaction is what surprises me, not what they believe. I think what they believe is misguided. because they don't really have enough information. So then we got to go to the total technical side, which is algorithmically controlled. And I think that's what's in process. So how do we want to trade this? If you're positioned, very difficult. You're in a very difficult situation because I don't really feel that the market just starts to break out, but it depends on when your expiration is and what levels you're at. But as a day trader, I intend to trade both directions. And we should be able to use our shorter time frame, like the 2 minute, the 1 minute, 2 minute, 5 minute charts and on up to effectively trade this, all the moves. It's going to be my plan. So, but right now, if it turns yet again, and I am expecting it under even this revised count, it should still swing lower. It should still find a lot of downside room. And here is my bigger number for the C, for wave C. If I start to break this down, once I do get the turn, then I'll run again, fibs, from there to there up to wherever this tops out to get our levels coming down. In the third wave that I kept thinking was in play already. On a minute level, it is. On a sub-minute level, yet to come. Over in the NASDAQ, it's pretty wild. It's the same deal. And so I will put in retracements. Come on. There, down to there. And you can see same deal. But they're pressing on it again. They start pressing on it. And to me, it truly ceases to be, oh, we're paying $12,130. It's a number. And they're trying to get something done or they're trying to cover something, but you can see it trades up at 130, and then next thing you know, it drops the bid. Right now in the NASDAQ, and I'm not joking, the bid was just 126 at 130. It's now somebody comes in and buys it up, and it's 137 to 140. And this is the volatility right now. How do you want to trade that? You can't. You can't. You leave it up to the big boys. They're doing a roll. They're doing whatever they do. This is not tradable. When you have a $2 wide market or greater, it's not tradable. The S&P continues to trade basically with a quarter point market. In the NASDAQ, I'm staying away, but here's the marks. 12,140, which they want to buff it up against right now. Then we have 12,189. Above 12,353, it throws it all into jeopardy, everything we've done so far. And makes it probably a lot more difficult to pinpoint as to where we're going and why. So, was I looking for this? No. Can I trade it? Yes, I can. It doesn't present the easiest picture if you're out there as a fund manager, or you have a large position, or you've got a position that's based on something that's not happening. And I, along with you, did not expect this big of a response off of what the federal government and its various agencies are intending to do to protect big money. So they're all showing their gratitude by not letting the market collapse. It doesn't mean it won't. It just means this is what's happening right now. I actually do need to leave it right here. Again, we're seeing gold rally strongly. We're seeing the dollar is, again, moving a little bit lower. So it's not a surprise. And Bitcoin, they got to have it now because the interest rates, it's all okay. It's okay to go buy into that right now. So it's however they need to react, we need to go with and be able to trade it. A lot of it doesn't make sense other than, whew, they're happy. And that I don't know why, because it is what it is. And our economy is not healthy. And the banking system is not healthy. And there will be more. But if this is how they want to react, well, this is what we got to go with. I'm going to leave it right there. Our next update will be on Monday, the 13th.